Here's a fact that will blow your mind. Every single time the US government shut down in the last 4 decades, the stock market didn't collapse. In fact, more often than not, it went up. Look at this chart on the screen right now. These are actual S&P 500 returns during past shutdowns. 2018, the market ripped nearly 15% higher right in the middle of political chaos. 1984, up 5%. 2013, solid gains. Yes, some shutdowns like 1987 or late 1995 dragged slightly lower, but the average? Neutral to positive. That's not opinion, that's history. And yet, every time a shutdown hits the headlines, what do people do? They panic, they freeze. They think the world is about to end and the last thing they should be doing is buying stocks. And that, right there, is exact mistake that separates average investors from psycho investors. Because the truth is simple. Shutdowns create noise, but in the noise lies opportunity. For those of you new here, this is Psycho Investor. I'm an ex-financial advisor who allocated over 10 million euros for clients across Europe. I walked away from the traditional financial industry because I realized the rules they teach you are designed to keep you safe, not to make you rich. In the last 3 years, I built my own 6-figure portfolio that yields over 20% annually, and I share it all publicly right here. I don't do one-on-one consultations anymore. I don't sell courses. What I do is show you transparently exactly how the real money is made. So let's set the stage. Right now, we are in October. Historically, one of the most misunderstood months in the market. Everyone remembers October crashes, 1987, 2008, but if you zoom out, October is not the month of death, it's the month of rebirth. It's the month where bottoms are formed, fear peaks, and positioning for the year-end rally begins. And then comes November, statistically one of the single strongest months for both the S&P 500 and the Nasdaq. Since 1950, November has delivered some of the best average monthly returns on record. Put simply, October and November are where the smart money quietly loads up before Santa Claus rally that retail investors completely miss. And this time, there's an extra twist. Not only do we have a government shutdown narrative creating fear and confusion, not only do we have the strongest seasonal window of the year approaching, but we also have a Federal Reserve that is very likely to start cutting rates again. Rate cuts are like rocket fuel for equities, especially for tech-heavy indices like the Nasdaq. Now combine those three forces, shutdown panic, Q4 seasonality, and incoming rate cuts, and you have what they call a psycho window. It's the exact type of setup where you don't just hold, you attack. And the weapons of choice here are SPY calls and QQQ calls. Not because we are gambling, not because we are chasing headlines, but because the math, the history, and the policy all align in our favor. In this video, I'm going to prove it to you step by step. We'll break down the real historical performance of shutdowns and why they don't kill the market. We'll dive into seasonality of October and November and why these 2 months are the most powerful setup you can play. Then I'll show you exactly how to implement it, which option strategies to use, how to size your positions, and when to exit. And finally, we'll talk risks, because I may be psycho, but I'm not reckless. By the end of this video, you'll know exactly why the best time to buy calls is when everyone else is scared of Washington headlines, and exactly why rate cuts could make this Q4 one of the most profitable we've seen in years. Shutdowns don't end bull markets, they start opportunities, and if you are serious about building wealth in a rigged system, this is your chance to do it like a psycho investor. Let's start with the historical truth about shutdowns. Since 1976, the US government has shut down more than 20 times. The headlines scream disaster every single time, but the S&P 500 tells a different story. On average, the market has been flat to slightly positive during shutdowns themselves, and significantly positive in the 12 months after. Take 2013 shutdown. 16 days of political chaos, and yet the S&P 500 rose over 3%. Or the 2018 shutdown, one of the longest in history, and stocks surged more than 10%. If you zoom out into that chart again, you'll notice a pattern. Yes, sometimes there's a dip in the days leading up to the shutdown, as fear and uncertainty build. But once the shutdown actually begins, the market tends to stabilize and then recover. Why? Because markets care about earnings, liquidity, and monetary policy, not political theater. Now let's talk seasonality. Since 1950, November has been one of the single strongest months for stocks. The S&P 500 has averaged nearly 1.5% gains in November, with a win rate north of 70%. The Nasdaq has been even stronger as tech stocks thrive in year-end positioning. October, despite its scary reputation, has historically delivered average returns slightly above zero. But what matters is the pivot it represents. October often marks the transition from market's weakness in August and September to strength in November and December. This is why traders say, buy when the leaves turn yellow. Combine that with the Federal Reserve is likely to do in the month ahead. After the fastest hiking cycle in decades, the economy is slowing, inflation is cooling, and rate cuts are back on the table. When the Fed cuts rates, liquidity expands, cost of capital drops, and risk assets, stocks, especially growth and tech stocks, explode higher. If you overlay past cycles, rate cuts tend to coincidence with some of the strongest rallies in equities. So, what's the play? This is where we go from history lesson to action plan. But before we go any deeper, let me tell you something crystal clear. Nothing you hear in this video is financial advice or a recommendation to buy or sell any security. I am not your financial advisor. I am just sharing my personal research, my personal opinions, and how I position my own portfolio. Markets carry risk. Options carry even more risk. You can lose money. You can lose all of it. Do your own homework, know your own risk tolerance, and never invest more than you can afford to lose. This channel is about education, not recommendations. So what's the play? We're going to split this into two clean lanes so you always know exactly what to do. Lane 2 is for advanced viewers who can handle options mechanics professionally without getting wrecked by theta and volatility. If you're a cautious newcomer, forget calls, forget spreads, forget anything that keeps you up at night. Your job is simple. Accumulate broad market exposure into the shutdown noise and into the strongest seasonal window of the year. Build your core with SPY or QQQ and add on weakness using 3-step ladder. Step 1, take your first third in early October. Step 2, add the second third of any shutdown headlines dip or red week. Step 3, add the final third in early November once price confirms seasonal strength. Keep it mechanical, not emotional. And if you're hungry for a little more torque but still want it simple, you can layer up into 20% of your equity sleeve into QQQ. Not more than 20. That cap matters because leverage cuts both ways. Rebalance winners, don't average down losers blindly, and let the calendar do the heavy lifting. October sets the stage, November performs, and Santa often writes the encore. Now, if you're more advanced and you understand options risk for real, not in theory, then this is a cycle window where options can compound your edge without blowing you up. The strategy is brutally simple. Buy deep in the money calls on the index you want to express, SPY for broader market, QQQ for higher beta to rate cuts, and give yourself time. I'm talking 6 months out with a delta around 0.7 to 0.8. Deep in the money calls behave like stock with built-in leverage and a fraction of the capital at risk. You are renting exposure, not gambling on a lottery ticket. Remember the video with Nancy Pelosi? Here's how to execute. Enter October with 1/3 of your intended options exposure using those 6-month delta 0.7 to 0.8 calls, and your second third on a shutdown-driven dip or a red or 2-3 day sequence. Add your final third in the first 2 weeks of November if the tape confirms higher highs and higher lows. Your plan from day one is to sell the contracts, not hold to expiry. The target hold time is 6 to 9 weeks, maybe 12. You are aiming to exit in late November or early December into seasonal strength and ideally into rate cut driven melt-up. If the market gives you a sharp rally earlier and your calls jump, take the gift. Risk and cash management are non-negotiable. Keep a meaningful cash buffer. I want you liquid enough to survive surprise volatility or to buy opportunity if we get it. Size each options entry so that the total premium at risk across all tranches is small relative to your portfolio. Think in max loss first not in hoped for gains. If the positions go nowhere for 10 trading days after your last add, or if price decisively loses the 20-day and can't reclaim it with 2 sessions, trim hard or close. If implied volatility balloons so much that your in-the-money calls stop responding to price, remember, you are allowed to take profits early or roll up and out to keep your delta where you want it without overpaying for Vega. Now the precise plan, and this is the one you'll want to write down. If VIX spikes through 40, real panic, not Twitter panic, I flip the switch. That's when I deployed the high octane sleeve. Advanced viewers can buy the 3 times leveraged indices outright, QQQ for the Nasdaq, SPXL or UPRO for the S&P. Not with rent money, not with margin you can't cover, but with the capital you specifically reserved for the asymmetric opportunities. True VIX over 40 moments don't show up often, and historically they've been some of the best entry points of the decade. When fear is maxed, I don't nibble, I attack. Then I manage it like a professional. Scale out into the first violent bounce. Reduce risk as volatility normalizes, and let the remainder ride only if price continues to confirm higher highs. One more refinement for the advanced lane. If you bought 6-month calls in October and we do get the expected November push, you don't have to overstay your welcome. Take the fastest half off when you are up meaningfully. Think in multiples of premium paid, then set a trailing stop on the rest into the Santa window. Remember, deep in the money calls are stock substitutes. They are designed to capture the directional move efficiently and then get out before time decay matters again. Tie it all together with discipline. Beginners accumulate SPY or QQQ in 3 steps. Keep TQQQ to 20% max and let the calendar do the work. Advanced traders buy time with 6-month deep in the money calls around 0.7 to 0.8 delta, scale in across October and early November, plan to sell in 6 to 9 or 12 weeks, ideally into Santa Rally, and keep a cash war chest on the table. And when VIX breaks 40, that's the psycho exception. Deploy TQQQ and SPXL with the intent. Then harvest the snapback like it's your job. That's the blueprint. Clean, repeatable, and built on history, seasonality, and policy tailwinds. Now, let's execute like psycho investors. Calculated, aggressive, and never reckless. I've been called crazy for saying things before. They'll say I'm crazy now for telling you to buy calls during a government shutdown, but history doesn't lie. Seasonality doesn't lie. Rate cuts don't lie. This is the moment. This is where psycho investors separate from the herd. If this opened your eyes, subscribe to the channel. More videos are coming every week, breaking down not just the news but the real opportunities hidden inside the noise. Shutdowns don't end bull markets, they start opportunities. And this Q4, the opportunity is here for anyone willing to take it. This is Psycho Investor, signing off.